You have $10,000 to invest. The market just hit an all-time high. Do you put it all in now, or do you wait for a dip? That single question is what this video is about. 2 strategies, real data, 1 winner. We're covering dollar cost averaging versus market timing, what they are, what the numbers actually show, and which one you should be using. Let's get into it. Segment 1. What is dollar cost averaging? Dollar cost averaging means you invest a fixed amount on a fixed schedule, every week, every month, every paycheck, no matter what the market is doing. Example, you invest $500 every month into an S&P 500 index fund. Some months the market is up, so your $500 buys fewer shares. Some months it's down, so your $500 buys more shares. Over time, your average cost per share smooths out. That's it. No prediction, no waiting, just consistency. If you have a 401k, you're already doing this. Every paycheck, a set amount goes in automatically. You don't think about it, and that's exactly the point. The biggest advantage of DCA isn't mathematical, it's psychological. It removes the decision. There's no, is now the right time, because the schedule answers that question for you. Segment 2. What is market timing? Market timing means trying to buy when prices are low and sell, or stay out, when prices are high, based on where you think the market is headed. The appeal is obvious. If you knew a 30% crash was coming next month, you'd hold cash, wait for the bottom, then buy in. That's not stupid, that's just math. The problem is, nobody knows. Not hedge fund managers, not economists, not the guy on financial Twitter who's been calling a crash since 2012. There are softer versions of timing, keeping a cash reserve for major dips, or shifting slightly more conservative when valuations look extreme. But the core challenge remains. To time the market successfully, you have to be right twice. When to get out and when to get back in. Most people get one wrong. Many get both wrong. Hey, if you're enjoying this so far, don't forget to hit the like button. It really helps the channel. Segment 3. What the data shows. 6:30 to 9:30. Charles Schwab studied 5 hypothetical investors who each received $2,000 a year to invest in the S&P 500 over 20 years. Perfect timer, always bought at the yearly low, $151,391. Immediate investor, invested January 1st each year, $135,471. Monthly DCA, investor, $134,856. Worst timer, always bought at the yearly high, $121,171. Cash hoarder, never invested, kept everything, $44,438. The perfect timer won, but only by $16,000 over 20 years compared to someone who just invested immediately without thinking. To earn that $16,000 edge, you'd have to correctly identify the single lowest point of the market every year for 2 decades. That's not a strategy, that's a fantasy. The real story is at the bottom. The person who stayed in cash made less than a third of the no-effort investor. Trying to time the market and getting it wrong isn't just a small penalty, it's catastrophic. JP Morgan Asset Management ran another analysis. If you invested $10,000 in the S&P 500 from 2002 to 2021 and stayed fully invested, you'd end up with around $61,000. Miss the 10 best trading days? You'd end up with $28,000, 10 days, out of more than 5,000. That's all it takes to cut your returns in half. And here's the brutal part. The best days almost always follow the worst days. The biggest rebounds happen during the most fearful, volatile stretches, exactly when people who try to time the market have moved to cash. They don't just miss the gains, they leave specifically because the gains are about to arrive. Segment 4, the psychology problem. The data favors staying invested. So why do so many people still try to time the market? Because our brains are terrible at this. Loss aversion makes losses feel about twice as painful as equivalent gains feel good. So we pull out to stop the pain, usually right at the bottom. Recency bias makes us assume the recent trend will continue forever. After a crash, we expect more crashing. After a bull run, we expect it to go on indefinitely. Overconfidence makes us think we're smarter than the average investor, even though by definition most investors are average. These biases don't just affect beginners. Dalbar has tracked actual investor behavior for decades. They're finding the average equity fund investor underperforms the S&P 500 by roughly 3 to 5 percentage points per year. not because they picked bad funds, but because they moved in and out at the wrong times. Compounded over 30 years, a 3% annual gap is the difference between retiring comfortably and running short. DCA doesn't fix your psychology, it bypasses it. The decision is already made. You don't have to be brave in a crash. The investment goes through anyway. Segment 5. Which strategy is right for you? Scenario 1. Regular paycheck, investing for retirement. DCA, automatically, every pay period. No further thought required. Scenario 2. You have a lump sum, inheritance, bonus, home sale. Vanguard's research shows lump sum investing beats DCA about 2/3 of the time because markets tend to go up and every day in cash is a missed day of growth. But if a 20% drop in month 1 would cause you to panic and sell, spreading it over 6 to 12 months is a reasonable trade-off. You give up a small expected return in exchange for staying the course. Scenario 3. You're convinced a crash is coming. Unless you have a specific predefined rule, I'll invest when the market drops X%. Waiting is just procrastination with a financial story attached to it. People have been waiting for the crash since 2013 and have missed years of compounding. Scenario 4. You're young and just starting out. Short-term volatility is almost completely irrelevant with a 30 to 40-year time horizon. Invest every month. Increase the amount when your income grows. That's the entire playbook. Segment 6. The verdict. If you could time the market perfectly, timing would win. But you can't. And statistically, neither can the professionals. Morningstar's research consistently shows fewer than half of active fund managers outperform their passive benchmarks over a 10-year period. DCA wins for most people because 1. It works without requiring any prediction or expertise. 2. It keeps you invested during the recoveries that matter most. 3. It removes the emotional decisions that cost investors 3 to 5% per year. 4. It buys more shares when markets are down, improving long-term average cost. 5. It's sustainable. You can do it for decades without burning out. Market timing is intellectually appealing because it implies control, but markets are priced by millions of informed participants. Consistently outsmarting them is, by the data, not a realistic expectation. The famous line from Jack Bogle applies here. Don't do something, just stand there. Quick recap. DCA means investing a fixed amount on a fixed schedule, no matter what. It's simple, it removes emotion, and the data strongly supports it for the vast majority of investors. Market timing means predicting market movements to get better entry points. It's appealing, difficult to execute, and most people, including professionals, fail at it consistently. For most people, invest regularly in low-cost index funds over a long time horizon. That's it. That's the strategy. If this was useful, subscribe. Drop a comment telling me which strategy you've been using. I read everything. See you in the next one.